already know the answer.
100%.
Not that good.
Vuol dire questo, già l'ultima volta.
Mi dispiace, ma
Poi speriamo che giusto.
Yes, yes.
Dovrebbe essere sulla.
Okay, good morning, everybody. Last lecture today, and then the exam next Friday. I don't know if you have any particular questions about what we discussed yesterday. Today, as promised, I want to use only 1 hour and a half, maximum 2 hours in order to conclude. As you can imagine, IFRS are a very wide topic, so I could teach and discuss with the students for not only 35 hours, but probably for 100 hours. But we need to define the topics to be discussed during 35 hours, and I think that the selection that I did is something that could help you in understanding financial statements on the one hand, and on the other hand, these topics could give you also the knowledge in order to, for example, attend some internship or starting a career in auditing firm or in the finance department of company. Today, so I would like to start from the exercise that we did yesterday. And I asked you yesterday to conclude the exercise. I share my screen for students that are at home. Okay. I would like to share with you also a slide about financial instruments. Just a brief recap. Financial instruments are the definition of financial instruments under IFRS is wide, okay? Because it's based to the concept of contract. So a contract that gives rise to a financial liability for the holder, and for a financial asset for the holder, and a financial liability or an equity instrument for the issuer. And since the definition of financial asset and the definition of financial liability at the end is based on the contractual right, this means, as we discussed yesterday, that a lot of assets and a lot of liabilities fall down the definition, so they enter within the scope of IFRS 9 and of the other standards about financial instruments. In particular, trade receivables and payables, but also the loans when they are receivable, so this means in the perspective of the bank, for for example, and on the other hand, in the perspective of the company that receives money, so loans, bonds, and mortgages, and so on. Yesterday, I simply presented the fact that under IFRS, in order to measure at the end of the reporting period a financial asset, it is necessary to classify the financial asset within 3 different categories. These categories, the subsequent measurement is different. One category at the cost, to be more precise, amortized cost, and 2 categories at fair value. The difference is linked to the part of the document where the company has to present changes in fair value, income statement, profit and loss, or other comprehensive income. We do not discuss here in this course the classification of financial assets, but I would like, yesterday we discussed together the measurement, the initial measurement and the subsequent measurement of financial liabilities. This is because for financial liabilities are present at the end in all the financial statements of all the companies, and they are important also for non-financial companies. Non-financial companies, they need money obtained by banks and other creditors, so they have to recognize financial liabilities. Yesterday we discussed together the fact that in normal situation, in regular situation, and luckily regular situation are most of the situations, 99.5% of the situations are regular. The interest rate obtained by a company is the market interest rate. And this is very important for us because this means that the amount received, the amount collected, is also the fair value of the debt. This is very important for us because this means that at the initial recognition, the financial liability is recognized at the amount collected, minus we need to take into account only the transaction cost. Yesterday we discussed together the fact that transaction costs are incremental costs directly attributable to the acquisition of the financial debt. And this is the case of upfront commission paid to the bank, but also the fee paid to advisors, legal advisors, financial advisors, and so on. So the amortized cost is just a method. First, focus on cost. So for financial liabilities, we are not interested in the fair value of the financial liability. Okay? So fair value, the market value, is not relevant when we measure a financial liability. So cost means simply the initial amount, the assessment, the measurement made at the beginning. The word amortized is just to highlight the fact that when there are differences between the initial amount and the amount at the maturity, more in general, differences relate to the difference between the nominal interest rate and the effective interest rate. the amortized cost. Amortized means that these differences are split, are divided. Here, amortizing means simply dividing these differences, these other costs, over the maturity of the debt. But amortized cost, these amortizing, these when we split these differences, we need to take into account the effective interest rate. Yesterday, we saw that the effective interest rate at the end, from a mathematical point of view, is simply the internal rate of return. And in the case of financial liability, we need to find the effective interest rate, that is the rate that makes the present value of the future payments equal to the initial carrying amount. And the initial carrying amount is the amount collected at the beginning, the fair value for us, minus the transaction cost. Okay? In fact, yesterday we saw this example. 95, the amount collected, nominal amount 100, nominal interest rate 2%, and so this means that for the company the effective interest rate is higher, because the costs are not only due to the interest paid, 2%, but also due to the difference between the initial amount, 95, and the amount at the maturity, 100. So the total cost are 5 at the beginning plus 2. But this initial amount of 5 cannot be recognized in the first income statement of the first year. This is a big mistake, because this 5, this upfront, these fees that the company pays at the beginning, at inception, they refer to a financial debt that has a maturity of 5 years. So we need to divide it, but under IFRS, we need to use the effective interest rate. Okay? So yesterday, we started this, not the computation, because the computation is already there, but the use of the amortized cost data in order to prepare balance sheet, income statement, and also cash flow statement. So if I go to this example, this is the example, exactly the example of the slide. Okay. We have here all the information. I would like just to add also the cash flow. Okay. And in particular, within the operating activity, there is the cash, the payment of the interest. So simply interest paid. Okay? This is very important, because I just want to highlight the fact that the payment is 2 for the interest paid at the beginning. Okay? And during the first year, the company, if we look at the financing activity, the company received money. But look at our double entry record. The cash inflow is not 100, but only 95. Pay attention, in real cases, in real situations, the company prefers to make more than one double entry. So it is highly probable that the company recognizes first the inflow of 100 from the bank, and then the payment of 5, that this 5 could be paid to the bank or to the advisors and so on. What is important at the end, it doesn't matter how many double entries records are used. What is important is that at the end, the debt is recognized at 95, because 95 is the fair value. In our regular situation, the amount collected, that is 100, minus
Transactions.
the transaction cost. Okay? So this means that in the financing activity, we have the proceeds from new debt that in our case are equal to 95. Is this clear for everybody? Then we have the year 2, 3, 4, and 5. If there are some questions or doubts, and here. Are you sure? Sure. Because, So, look, the interest paid for the second year is always 2. But the interest expense to be recognized is 3.23. But since we pay only 2, in order to obtain to recognize, in the debit side 3.23, as if we are paid only 2, we need to increase the amount of the liability for this difference, 1.23. So we start from the previous amount, we add 1.23, and the amount of the debt is 97.42. During the second year, there are no other payments other than interest paid, So we don't have any proceeds from the deriving from the debts, and also any payments for the reimbursement. Okay? Second year, we pay again the interest. It is always the amount paid is the nominal interest amount. The bank is interested in obtaining the nominal interest rate. Okay, 2. But if we apply the effective interest rate, now the interest expense to be recognized in the income statement is 3.27. So minus 3.27. But again, the amount paid is only 2, so we need to increase the debt for 1.27 in order to obtain 98.69. No proceeds, no payments. Last year, the amount paid for interest is always 2, but the amount to be recognized in the income statement for the interest is 3.31 minus 3.31, but the last year the company has to pay the reimbursement of the debt. So in the cash flow statement within the financing activity, we need to recognize the outflow of cash of 100 for the reimbursement of the debt, for the reimbursement of the principal. And at the end, once the amount is paid, the amount of the debt shown in the balance sheet, of course, is equal to 0. Is this clear for everybody? This mechanism is the mechanism that works also in the Italian GAAP for companies that are not small. So small companies, they can avoid the amortized cost. They can simply divide 5 over 5 years using the straight line method. But also in Italy, for non-small companies, financial debts must be measured using the amortized cost, that is this method. Is this clear for everybody? And
Professor, can I see the PowerPoint?
sorry?
The PowerPoint.
Yes.
And the amortization differences between initial and maturity amount is it's 5.
Yeah.
Regarding the 29 we have on the first year, we got from the bank, yes,
25.
95.
95.
Yes,
95.
because you start from 95, okay? And your goal is to obtain 1 second before the payment 100. Okay? So with the effective interest rate, this the amortization that is this at the end, this double entry record. This is the double entry record at the end of year 1. At the end of year 2, you make the same double entry records, but with 1.23 and so on. At the end, the total amount is 5. Exactly the difference between the initial amount and the amount in maturity. Exactly. Is this clear? Yesterday, we started the analysis with another case, but it's very, very similar. Okay? I asked you to compute the effective interest rate. In order to compute the effective interest rate, for example, you can simply use in our very simple example. Our examples are simple because the payments are done always at the end of each year. So yesterday, when I show you the formula in order to compute the effective interest rate, we used the formula, the simplified formula. In Italian, TIR DAP cost. In English is, if I'm not wrong, IRR that cost or cost that IRR, something like this. Okay? And it works, as you can see, we do not need to include the dates, but only the outflows and inflows. This is because the payments are done always every 12 months. Okay, this is important. There is the other formula that is more complex, that can be used also when the payments are not done every 12 months, but every month or every 15 days or whatever. And in our case, oh yes, because there is a very important amount missing, that is payments, okay? And in this way, we can see that the effective interest rate is 3.33%. This means that if we compute the amortized cost chart, we start from the end of the various reporting periods. So we are at the end of year 1, 2, 3, 4, and 5. Okay. We need to show the initial amount. I mean the initial amount at the beginning of that period. The interest rate to be recognized in the income statement. That is the interest rate at the effective interest rate. We have some payment for interest, payments for principal, the amortization of the difference, and the final amount. Okay. In our exercise, since we always consider and only consider payments done every 12 months, always at the end of the reporting period, as you can imagine, in real world, we can pay in all the possible days of the year, but our exercise, this means that it is quite easy also to determine the interest rate, because this is our starting point. The interest rate, since we always compute the interest rate for 1 year, the interest rate is computed simply by applying the effective interest rate to the initial amount. Then we have the cash flow for interest, the cash flow for principal, the amortization, that is the difference between the effective interest rate and the cash flow for interest rate, and the final amount, that is equal to the initial amount plus the amortization, but minus the principal paid. I have some problem. A and of course F. A plus the amortization minus the amortization minus the reimbursement of the principal. Is this clear? This is exactly what is in the chart. I prefer to draw up with you another time all the amortization chart so that you can understand all the mechanism again. Okay? So, how much is the initial amount? How much is the initial amount?
1 million? 1 million?
No,
Nine.
No.
900.
This one. Because the initial amount is always the fair value less the transaction cost. So the initial amount is 985,000. Okay? Look at this double entry record. Okay? The interest rate to be recognized in the income statement is at the effective interest rate. So initial amount multiplied by the effective interest rate. Since we are considering 1 year, it is the enough to multiply by the effective interest rate. The payment, the cash flow for payment is 30,000 because this is the amount paid, and the amount paid is based on the nominal interest rate, on the nominal amount of the principal. At the end of year one, we don't pay any reimbursement, so it is 0. And this means that we need to recognize in the income statement 2,806 euro in the interest expense. So this means that at the end of year one, we pay the interest, and so we recognize the interest paid, and the amount of interest paid is 30,000. But in this way, in the T account debit side, we have only 30. We want to have 32,800. So we need to make another double entry record in order, I don't remember exactly, mortgage, okay, in order to increase the debt for exactly the amortization of the difference. Is this clear for everybody? So, how much is the amount of the debt at the end of the reporting period? We start from the initial amount plus 2,806 minus, in this case, 0. But it is possible also to reimburse the debt over the period. In these two examples, the amount reimbursed is 0 for year 1, 2, 3, 4, because the whole amount is reimbursed at the end. No particular issues if there is a reimbursement through the different over the period. The mechanism is always the same. You simply, of course, if you pay, look at the slide. If you pay, you start from the amount at initial recognition, but then minus the repayments of the principal, plus or minus the amortization of the effective interest rate, and so on. So, at the beginning of year 2, the initial amount is 985. If I'm not wrong, this is the effective interest rate. Yes. Okay. So for the second year, we compute the interest in the same way. We start from the effective interest rate. We start from the initial amount, 987. We apply 3.33%, that is the effective interest rate, and we obtain the interest rate in the interest expense in the income statement. But the cash flow for interest is always 30. 0 is the amount reimbursed, so the amortization of the difference is 2,900. So again, look, year 2, we pay again the interest. The interest paid is 30,000 for the second year. This is the outflow of cash. But we want to have in the income statement an amount of interest that is higher of 2,900 euros, and so we increase the mortgage for the same amount. So the amount of the debt at the end of year 2 is 990,000 and something. And then the same. We compute the interest for the third year a little bit higher because the effective interest rate remains constant. But the amount of the debt is higher, so the amount of the interest is higher. The interest rates are always the same. The principal reimbursed is always 0. So the amortization now is 2,996. So again, year 3, interest paid, always 30,000, because this is the amount paid also at the end of year 3. And then again, we need to increase the interest against the debt. And for the third year, 2,996. We increase the debt, and of course, this means that at the end of year 3, the debt is 993,703 euros. The amount of the end of the period is also the amount at the beginning of the period. We compute again the interest. We compare with the interest paid. The principal is always 0. So for the fourth year, the amortization is 3,096. So year 4, interest expense and the debt. 3,000 and some. Before this, we need to pay. We need to pay, and we always pay 30,000. Is this clear for everybody? Then, this means that at the end of year 4, the debt is 996,000. The amount at the end of the period 4 is the amount at the beginning of period 5. The interest to be recognized is 33,191. The payment for interest is always 30,000. But during the last period, we pay also the principal, 1 million. The amortization is now 3,199. So now, look, year 5. Interest expense, bank account. Always 30,000. Then, same mechanism. We need to recognize the interest expense towards the amount of the mortgage. and this is 3,199. Okay? Now please look. Now I compute the carrying amount of the mortgage on December year 5 before the payment of the reimbursement. Okay, before the payment of the reimbursement. And I follow exactly all the double entry records. Okay? At the beginning, the mortgage is recognized at 985,000. Then, at the end of year 1, is increased of 2,800. At the end of year 2, is increased of 2,900. At the end of year 3, is increased of 2,996. At the end of year 4 of 3,096. At the end of year 5 of 3,199. 1 million. So this means that when the company pays, the company de-recognize, to be more precise, the mortgage because the amount is paid. So there is an outflow of cash of 1 million. And since in the T account of the mortgage, the amount now is exactly 1 million, after the last payment, the debt in the balance sheet is recognized at 0. Is this clear for everybody? There is a question in the chat. Elena, I'm using exactly the result of the effective interest rate. Okay, so as you can see, it's not exactly 3.33, but it's 3.33, 063, and so on. Since I use exactly the cell of Excel, the result is precise. For companies, they use exactly Excel or other tools, so they have a result that is precise. At the exam, of course, it doesn't matter. So we provide you the effective interest rate. When there are some rounding, it's for sure that it is impossible to obtain exactly 1 million at the end if the interest rate is rounded. Okay, there will be some little difference, but it doesn't matter. Okay, so Elena, the reason for having a slight difference is due to the fact that I used Excel, and using Excel, of course, I can use all the digits after the comma. At the exam, it doesn't matter, of course. Okay? So, in this way, of course, at the end, is exactly 0. Is this clear for everybody? And at the exam, of course, you cannot use Excel, so you cannot compute the effective interest rate. Because without Excel, it's a long job. But at the exam, what is important for us is that you have understood the mechanism. So, for example, we can provide the chart, and we can ask you, for example, to present the financial statement for year 3. Or we provide the chart but with some missing values, so that if you have understood the amortized cost mechanism, you will be able to compute the missing value and then to prepare the financial statement for that particular year. Moreover, we can provide you the effective interest rate, or we can give you the information about the debt, like in this case. Okay? The nominal value is 1 million, the maturity is 5 years, there is a nominal interest rate of 3%, and there are transaction costs of 50,000. Then, instead of providing you just the effective interest rate, we can ask you first to tell to us if the effective interest rate is higher or lower of 3%. And then we can provide you, for example, 3 interest rates. For example, an interest rate that is lower than 3%, 3%, and then another that is higher. Okay? So in this case, you do not need to compute by yourself the effective interest rate. But if you have understood the mechanism, it is very easy and also very fast to identify that if there is a difference between the initial amount and the amount of maturity, the effective interest rate cannot be equal to the nominal one, 3%. The effective interest rate must be higher than the nominal interest rate. So the only possibility is the third, 3.33. Okay? Is this clear? So for us, it's important that you know the use of Excel, and that you know that in Excel there are a lot of formulas that you can use to make financial computation. This is helpful because not for the exam of mathematics, but for yourself, for your future job, also for your personal life, because maybe you don't remember exactly how to compute the present value of an annuity of 5 years, but it doesn't matter. In Excel, there is the formula if you have understood the problems and the solution of the problem. Okay? And at the exam, so you are not requested to compute the effective interest rate, but you are requested to have understood it, and so also the mechanism and so on. There is a question in the chat. No, the effective interest rate can be equal. For example, if I copy and paste, okay? It could happen, even if it is not so common, but it could happen that there are no transaction costs. Okay? So if there are no transaction costs, look, this is the computation. If there are no transaction costs, the effective interest rate is equal to the nominal one, because the initial amount is equal to the final amount. And in this case, the right answer is 3%. In this other, the right answer is 3.33. Okay? Then There is a particular situation, not for mortgages, but for bonds. Very particular situation, I repeat again, not for mortgages, but for bonds. It is possible for bonds that are issued not at the nominal value, not at par, but above par. It's not so common, but it could happen. Bonds, for example, for which the initial amount collected, in this case, is 20, is higher than the nominal one. Okay? In this case, as you can see from the computation, but the computation is just the evidence. Okay? Because if you collect 1,020,000, but if you pay the 3% of 1 million, if you need to if you need to pay back 1 million, this is a good for you if you are the company that has obtained the money, because you obtain 1,020,000, but you pay interest on 1 million. So this means that the effective interest rate, as you can see, is lower. Okay? Look, when it is equal, of course it doesn't make sense. Look at the chart. Look here. When the effective interest rate and the nominal interest rate are equal, there are nothing to amortize. So the final amount of the debt is always 1 million. Is this clear for everybody? Look, now, third situation, if the effective interest rate is lower, look here, there is something that doesn't work, of course, because the initial amount is the amount collected, 1,020,000, and look, as you can see, the mechanism works again. Now the starting point is 1,020,000, but the effective interest rate is lower than 3%. You pay 3%, but in the income statement we need to recognize only 26,000. So please, what is the double entry record that the company has to do at the end of year 1 in order to comply with the amortization cost, amortized cost?
Reverse.
The opposite. So the company pays always 30,000, but then succeeds, of course, minus in the double entry records cannot be used. The effective interest rate, the interest expense must be reduced. So the interest expense is debited for 30,000. Our goal is to obtain 26,000. So, as your colleague here in classroom had just said, we need to make the opposite, exactly the opposite double entry, so to reduce the amount of the mortgages. And of course, the same for all the years. Is this clear for everybody? Thank you for your question. Ivan. So in this way, you have seen all the possible situations. Okay? Any questions? Very good. If you don't have any other questions, I would like just to tell you just a few things about the trade receivables in particular. The slides, here are the slides of the financial statements, of the financial instruments. And what I would like to highlight is the fact that think about trade receivables. Okay? Trade receivables are recognized according to IFRS 15 revenue. So we need to verify when the revenue can be recognized and when the company has the right to collect, we recognize a trade receivable. If we recognize a trade receivable, this means that the company has allowed the customer to pay with some delay. The delay could be a very short delay, 1 month, or 3 months, or 6 months. It depends on the industry, customers, and so on. But the problem is that if you allow your customer to pay with a delay, there is a credit risk. You bear a credit risk because you don't know if your customer will be able to pay. Is this clear for everybody? And this means that under IFRS 9, companies, they have to make an estimate of the expected credit losses. It is necessary to make an estimate of the expected credit losses. Pay attention. The mechanism is called impairment test because the words impairment test are very generic. Impairment test means test in order to verify whether the carrying amount is recoverable or not. The impairment test that we discussed last week is called non-current asset, tangible asset, intangible assets, goodwill. Here we are talking of another type of impairment test, that is the impairment test prescribed by IFRS 9, specific for financial instruments. As you can imagine, this impairment test is crucial for banks because in the asset side of the balance sheet of a bank, there are loans. And in that case, the loans, the money lent by a bank has a very long maturity, 2 years, 3 years, 4 years, and so on. In this course, we do not analyze the banks, but for me what is important is just to give you the indication that in the balance sheet, trade receivables, they are not presented at their nominal value, but the trade receivable shown in the balance sheet are the result of the difference, the nominal amount minus the allowance for the expected credit losses. Okay? This is the net carrying amount shown in the balance sheet. So suppose that the company has 1 million of trade receivable outstanding at the end of the period. You don't read 1 million in the balance sheet because the company has to estimate the expected credit losses. I cannot tell you a percentage because this depends on the industry, the type of customers. It depends on the period. As you can imagine, during 2020 and 2021, some industries have been strongly affected by the pandemic. So for this type of industry, probably the expected credit loss in 2020 and 2021 are higher compared to the past experience. Okay? But suppose that the expected credit losses are equal to 50,000. This means that the amount to be recognized in the balance sheet, to be shown in the balance sheet, is only 950,000. If this is the first year of activity for the company, this means that the allowance at the beginning of the period is 0, if this is the first year of activity. Okay? So, during the period, the company has recognized a lot of trade receivables. Most of them are collected. Trade receivable outstanding at the end of the period are 1 million. So this means that we have in the T account 1 million. If we estimate an expected credit loss of 50,000, this means that we need to recognize the expected credit loss. Sometimes we use also ECL, expected credit loss. This is a loss to be recognized in the income statement. 50,000. And on the other hand, an allowance for the expected credit loss on trade receivable. Sometimes this allowance is also called allowance for doubtful receivable. Sometimes, because of course too easy to use the same word, just to confuse students that started the studying IFRS and accounting, there are a lot of different ways of naming this allowance. Allowance of trade receivable, allowance for doubtful receivable. Sometimes it's also called, but pay attention, provision for bad debts. That's strange because of course the other party has a debt. Okay, we have a receivable, but they are bad because this is the estimate of the possible insolvency of our customer. Okay, so a lot of different words for identifying this amount. Pay attention, this is very important. This allowance is not shown in the right side of the balance sheet. But this allowance reduces the amount of trade receivable. Companies, they prefer to use an allowance. It's like the accumulated depreciation, the same mechanism. Because in this way, they always have the information about both the nominal amount and the allowance. Is this clear? Then, second year. Fortunately, part of our estimate becomes current losses, not only an estimate losses, but to be more precise, an actual losses. Okay? So when a trade receivable is derecognized because it is sure now, maybe because of bankruptcy or because we, after trying to collect that receivable for many months, we say, okay, I stop trying to collect that receivable because it's impossible. So when the trade receivable is eliminated because it becomes sure not to be able to collect it, in your opinion, what is the double entry record that the company has to do? If I'm not wrong, this was part of the pre-counting course. In the IFRS, it's exactly the same. What is the double entry record when the trade receivable is eliminated?
The company has to record the loss of credit.
The company has to recognize the trade receivable. In order to recognize the trade receivable, so it's suppose not for the full amount, but suppose the trade receivable, nominal amount of the trade receivable, for example, 30,000. Okay, so we need to eliminate the trade receivable. Trade receivable, the balance is debit, so in order to eliminate it, credit. Okay, and what about the other side? Exactly, because we have already taken into account the loss during year one when we made the estimate. Now we simply use the allowance, okay, and this way the income statement is not affected in year two, because the income statement was affected in year one when we made the estimate. Okay? So, what are the movements about the allowance? So we have the allowance for the expected credit loss on trade receivables. Okay? The amount as at 1st of January year 2 was 50,000. The amount at the end of the previous period. Then, during year 2, we have used the allowance for 30,000. Use or utilization of allowance for 30,000. There are no impact on income statement. Because the impact, I repeat again, was recognized in year 1. But at the end of year 2, there are new other trade receivable, and we need to compute again the allowance, the total allowance, okay? So suppose that this is the estimate for year 1, and suppose that our estimate for year 2, now we have, I don't know, 2,500,000, too many zeros, 2 million of nominal amount of trade receivable, and according to the estimate of the company, the new allowance must be of, for example, 150,000. Okay? So this means that the amount shown in the balance sheet now is 2,350,000. But look at our allowance. The amount at the beginning was 50, but it was used for 30. So now the balance is 20, but we want to obtain 150. So the increase for new losses to be recognized in the income statement is 130. Because in this way, if I'm not wrong, the final amount of the allowance is exactly the amount estimated by the company. That. Okay? This is, oh my. This is the impact on the income statement. This is the loss that we need to recognize in the income statement. Because at the end of the second year, the company has to increase of 130 the allowance, so the company has to recognize an expected credit loss on trade receivable for 130, and the allowance for expected credit loss on trade receivable is increased exactly of 130. Clear for everybody?
What is the difference between provisions and allowances?
Good question. IFRS, they use the term allowance for trade receivables. The allowance is used in order to reduce the amount of the assets. Okay? Some companies, I repeat again, they use the term provision, but it's a non-appropriate word according to IFRS. When provision is used for trade receivable, the company they want to identify the allowance. Provision are completely different. There are some slides, and for example, I think that the slide 4 of provision, that is the definition, it's it's useful in order to answer to your question. Provision is a liability. So the allowance is the reduction of the value of an asset. Provision is due to a different situation, a situation that can generate a liability. So for an allowance, the problem is that you don't collect money. You expect not to be able to collect money from the customer. For the provision, your estimate is to have an outflow of cash because it's a liability. A provision is present when, so as you can see, sorry, I think that this is important. Provision is a subset, a subcategories of liabilities. A liability like trade payable or mortgages, the timing and the amount are certain. When there is a provision, this is a liability, but there is uncertainty about timing and or the amount. So it's a little bit, it's more complex compared to a liability, of course, because for a liability, you know everything. You know when you have to pay and the amount that you have to pay. For a provision, it's probable that you have to pay, but it is not certain. And in most of the cases, it is not so, the amount is not certain too. And also the timing is not certain. In order to have to recognize a provision, there must be an obligation. An obligation can derive from the law or from a contract, legal obligation, and or from the practice of the company, constructive obligation. I'll give 2-3 examples. When you buy a product like mobile phones, for example, it's there is a period of warranty. So the company has the obligation to substitute or to repair the mobile phone if there are some defects, if there are some problems in the product. So not because you don't like the product, but because the product does not work as intended, as described. Okay? The legal period of warranty is not defined by the company. It's mandatory by the law. This is a legal obligation. Suppose that in Europe there is a certain period of warranty. You sell also outside Europe, but quality for you is very, very important. So you declare, for example, that you apply the same warranty period applied in Europe, also in other countries. But you don't write this in the contract. It's simply a general statement. Maybe you write this on your website. You declare everywhere that quality is important for you. So this is a constructive obligation because your practice, your behavior is able to generate in the third parties the expectation of a, in this case, of your that you intervene in case of problems in the product. Another example, pollution, damage to the environment, and so on. In Europe, laws are very, very restricted laws. So if there are cases of pollution and so on, the company is obliged to intervene by law, legal obligation. In other countries, laws are less restrictive, also in the USA, and also in other countries all over the world. So if you declare that you will pay the same level of attention to the environment, to pollution, that you are obliged to follow in Europe because of the law, but also outside of Europe because of your mission, because your intention, this is a constructive obligation. Okay? In fact, in the slide number 6, here you can see some example of provision, warranty, restructuring, onerous contract. I would add also litigation. But litigation when you are subject to a litigation. Sorry. Here, slide number 8. When in order to recognize a provision, 3 criteria must be present. There must be the obligation, must be the result. So the obligation must be present, so actual at the end of the reporting period, as a result of a past event. For example, you sell something in 2021, this is the past event. At the end of the reporting period, 2021, you have the obligation to intervene for warranty for 2 years, for example. But this is not enough. The provision is recognized only if the company estimates the outflow of resources as probable. Probable means a probability higher than 50%. An event is more probable to occur than the opposite, so 50%. And you must be able to determine the amount of the obligation. So the typical obligations are for warranties, for restructuring, but most of all probably for litigation. Litigation means that, for example, tax authorities think that you had to pay a certain amount of taxes that you hadn't paid. And if you pay, this is not the provision because you pay. The provision could be necessary if you start a litigation with the tax authorities, because the tax authorities claims that you should have paid, 1 million more in income taxes. You claim that no, the amount that you paid is the right amount. So if we start the litigation, the company has needs to estimate if there is a present obligation of a past event, and more or all, if it is probable an outflow of resources. Then, if it is probable, it is necessary to verify if it is possible to determine the amount of the obligation. As you can imagine, for warranties, it is difficult, but not so difficult, because you have the experience. So Apple knows how many phones must be repaired, so the number of interventions, if there are more repairs or strong repairs. So Apple, but also Samsung and so on, they are able to make this estimate. It's not difficult because they have an experience. For litigation, it's completely different because each litigation is a completely different story compared to the other litigations. And as you can imagine, at least at the beginning, if you start the litigation, I mean, if the tax authorities claims for 1 million of income taxes, and if you start the litigation because you think that the amount requested by the tax authority is not based on a violation, a breach in the laws, this is because you think that you are right. This is because you think that you can win the litigation. So at least at the beginning, the company considered not probable the outflow of cash. I don't know if it is clear. So for litigation, it's very, very difficult to make the estimate. In particular, at the beginning of the estimation, at the beginning of the litigation. And this is a final chart that you can use in order to verify if it is necessary to recognize a provision or not. First, you need to verify if there is a present obligation as a result of a past event. If yes, you need to verify if the outflow is probable. If the outflow is probable, you need to make a reliable estimate, and in this case, you need to recognize a provision. Otherwise, if the present obligation, the obligation is not present, actual, but only possible, in this case, if it is a remote obligation, you need to, remote obligation, you do nothing. If the obligation is only possible but not remote, in this case we have a so-called contingent liability. Contingent liabilities are not presented as liability. Look, read here, they are only disclosed. So only some information, disclosures, must be provided in the notes. Okay? If the outflow is not probable, again, sometimes it is necessary to disclose as contingent liability. Some other, if the amount is not significant, if the amount is only remote, you don't do nothing. So in order to recognize a provision, the obligation must be present, the outflow must be probable, and the amount must be, the company must be able to estimate reliably the amount. If one of these conditions is not met, we can have contingent liability, the case of contingent liability only disclosures, or if the event is remote, the amounts are not significant, you don't do nothing, neither disclosure in the financial statements. Okay? And now I think that we can have a break of 20 minutes. After the break, we can have a look at E&I financial statements in order to understand how the allowance for credit losses are presented and how provisions are presented. 20 minutes break.
Esatto. No, un'altra. Sì, un'altra. Dell'ottobre scorso, se non sbaglio. Questo qua. All'inizio era simile. Come faccio a questo? Sì, abbastanza forte. Si forma. Sembra giocare. Se noi nel campo abbiamo solo più vendita per ottenerci. Io con tutto. Prima calcoliamo preso per ottenere quello e poi calcoliamo il resto. Poi tutte e due. Quindi poi perché ogni volta che ne conto di più devo mettere del presidente in causa e poi l'incest ma su bilancio su balance quindi la parità viene il primo e il secondo struttura secondo e seconda perché il primo stimo però il primo continuo sempre a stimolare. Sì, esatto, però la prima perdita effettiva c'è un secondo anno. Esatto. Poi dopo non so, di quei 150.000 quanti diventeranno effettivi, potranno essere di più o di meno, dipende.
周之前再给我自己安排一个欺骗人。
我就感觉我可能还没有把那个弄成一个 cycle。对。
就是你像有的时候包括你像我现在每天早上就麦片，主要它是快，而且我对麦片有一种执念，就是你看我们家那边会有3种到4种不同的麦片，我会混在一起吃。然后就是一种，当你形成一个习惯，你就会每天都很。然后有的时候我就想说，有点时间我就做一下运动，可能是习惯性的去运动。如果不做，我会觉得好像今天少了点。对，但是我不会说是因为我吃太多了或者干嘛，我逼着我自己一定要运动，我不开心我一定要去运动，那就没必要。
因为我感觉现在就是要么就再瘦一点，然后保持住，主要是保持最难。
其实慢慢的就好一点，就我们因为你想啊，人是一天吃不成一个胖子，所以我们减肥肯定也是要或者减肥或者减脂，就是不要太急着来。只要假如说可能每个月能瘦个1公斤，是稳定下来瘦的1公斤，其实就挺好的。因为本来咱就没有多少公斤，再说一下。
对。我觉得那样反而反弹的特别，因为我以前有过那种经历，就是我自己逼得特别狠，就是把自己弄得特别严，但是到后面就直接就崩溃了，就直接就不吃海，就感觉吃不饱的那么一天，也不是一天，1个星期都会有那种。
有没有合适的口啊？就是沙拉菜呀，或者是之类的。其实我也会吃的很好。你看我有的时候可能会就是做类似于像黄焖鸡一样的炖的这种东西，但是我有的时候假如说我今天想会注意一点，我就把皮去掉，我不吃皮。我有的时候我们就卤鸡腿多好吃，对不对？你如果很怕胖的话，那你也把皮去掉就好了呀，对不对？而且我一般做饭时候我油一点，因为我不是很喜欢吃太油的东西。对，然后有的时候很想吃点碳水，如果就是控制不住了，你尽量把它放在早上跟中午，晚上的话想吃可以少吃一点，有可能会不好吃的，或者说我看着那个薯片我好想吃，那就吃2片。我跟我说，咱也不是去选美去健美去干嘛的，让自己稍微开心一点。就是说，如果说很想吃肉，那假如说吃猪肉或者五花肉会胖，那我们稍微尽量控制一点，换成牛肉，对不对？换成鸡肉，对不对？就是不能太过于苛求。因为我一直都，我有的时候我是有点奇怪，小的我会觉得说，谁也不知道明天会发生什么，也不是说悲观，但确实就这样，你会发现身边可能突然有一个人就没了，或者干嘛了。那我如果不想说，或者让我天天就是很不开心的话，我知不知道？所以就是天天试一天，所以有的时候你就想老外的那些生活想法，就是赚一天花一天，到底为什么？万一你就是没了，你的钱花出去，你的这个干嘛？学他们的一点，然后保留我们自己的一点，然后混在一起。
感觉就等于，你的生活状态真是太好了。
感觉我已经要剃头。
挺向你学习，我感觉我自己活得好累啊。
不是看那个，因为以前我其实是属于也是属于想很多的那种人，但是就是后来
那有时候就感觉
很正常，包括我也是某一个时间点会看，就是突然一下就紧张，整个人自己就爬不回来，就只能自己消化过这个时间，找一点喜欢做的家伙就特别生气，那我可能就一直做那个仰卧起坐，举个例子，或者是某些东西，然后弄到累竭就累的不行的时候，我就不会再想。
我感觉我自己给我自己的那种目标特别多，就是你要这个人，然后
就完全这样，假如某一天你不要说你干嘛的时候，会对自己导致失望，或者让自己更大的一种压力，这样的话你会发现反而说最后它的效果可能并不是很好，那我们反而就是说有目标或者说是有想法是对的，这个方面不是说不对，但只是说我不要把我自己太强迫压到那个里面，因为只会适得其反。那我们倒不如说，比如说举个例子，我这个月我就要背1000个单词，太难了。那样很有可能到最后你就只有前3天 是背了，那你倒不如说我这个月我就背500个人数，我每天都能坚持下来，我可能这个月我真的学了500，但是如果要是那个我给我自己让我背1000或者3000个，我可能学的更少。
真的。
我觉得已经我们自己在外面生活就已经不难受了，还要给我们自己那么多压力。你说实在的，家里面人也会担心，尤其像咱们应该一般很多报喜不报忧嘛，之前不想担心。那这种情况下，男母自己都已经够压抑了，就是尽量找方式、找方法让我们自己稍微变得开心一点。假如我今天就想吃螺蛳粉，那我就吃。因为像我是觉得我很想吃完之后以后，太臭了。
而且我是那种每次特别想吃一个东西，吃完以后我就会，好吧，第二天我必须得克制了那种，就一定要把那个给克制。
只是每年1周至少要有1次是欺骗餐，但是这个欺骗不是说胡吃海喝想吃肥的全都吃，你可以在高碳水上面注重，或者是高蛋白的高脂肪选一个就好，就不要太过于。吃是没关系的，然后给身体2天时间，第2天你可以不要去立马给称体重，因为你肯定会水肿。
我不称了已经。
给2天时间，你就会我们在恢复正常的饮食，就慢慢的就会好，然后身体也会习惯，因为如果你一直不吃欺骗餐的话，你的身体会习惯了我们每天吃很少吃的这个情况，那后续就再也不会再消耗了，就不会再吃了，一定不能骗他。
Okay, we look at E&I. In order to read the disclosure about, on the one hand, about the expected credit loss of trade receivables, and on the other hand, about also provision. This is the consolidated financial statement of E&I 2020. And here, trade and other receivables, 10.9 billion. So this 10.9 billion is the nominal amount minus the allowance for the expected credit losses. Here we have the note number 7 with the details, and in the income statement, here, net impairment losses reversal of trade and other receivable. And here the note is the note number 7. As you can see, in the case of E&I, there is a specific item in the income statement with the amount, pay attention, of the loss recognized in the income statement. Okay? So if we look at our exercise, this is the same as 130. So this amount is not the amount of the allowance. This is the amount of the increase of the allowance in 2020 due to the adjustment of the allowance in order to obtain the amount that is necessary in order to recognize all the expected credit losses. And if we go to the notes, here there is the general description. In order to read the notes about the trade receivable, we need to read the note about financial instruments, because financial trade receivable is a financial asset according to IFRS 9. So as you can see here, the title of this part of the note is financial instrument, and there is a paragraph dedicated to impairment of financial assets. I don't want to, the method in order to determine the expected credit loss can be a simplified method, that is the method used for trade receivable, or for a more complex method, that is the method used for all the other financial assets. I'm not interested here in the complex method, but also to the trade and other receivables. For trade and other receivable, ENI determine the expected credit loss using different methods. It depends on the type of customer. ENI, some of the customers of ENI are big companies, but I am a customer of ENI because here in Turin, for both the energy and gas, my provider is ENI. So as you can imagine, it's not the same for ENI to determine the expected credit loss for very big, large customer or for very small customer like individuals. So here there is all the details, there are details disclosure, and in particular for customer like individuals, so customer for which the internal credit rating is not available. As you can imagine, ENI cannot determine a rating for Donatella Busso or Mr. Rossi. It doesn't make sense because ENI has a huge amount of very, very small receivable towards millions of customers. And so they use a so-called provision matrix. So they decide the amount of the expected credit loss based to the experience adjusted in order to take into account also a forward-looking information on credit risk. So the experience is the basis for ENI in order to determine the expected credit loss. This basis, the experience, is then adjusted in order to take into account new information that can change, then can improve or can also worsening the expected credit loss. This is the generic narrative. If we go to the note number 7, here, trade and other receivable. As you can see, out of 10.9 billion of trade and other receivable, trade receivable are equal to 7 billion. And trade receivable do not bear interest, and the regular delay of payment is less than 180 days. Then there is all the indication about the definition of the credit risk. What is important here for us is this chart. It is a summary in quantitative terms of the explanation of that ENI provides in order to determine the expected credit loss. Look, the net amount of trade and other receivable is 10.9 billion. But the gross amount, that is the nominal amount, is 14 billion. That is equal to our 2.5 million in year 2. The amount is reduced for the allowance for doubtful accounts. The amount of the allowance as at the end of 2020 is 3.1 billion, almost 3.2. Okay? So if we compare these figures to our exercise, 14 million is like our 2.5 million. The allowance of 3.15 billion is our 150,000. The net carrying amount, 2.35 million, is for ENI 10.9 billion. In this chart, we can see that trade receivables are analyzed in different ways. Any ENI gas and luce customers for foreign students, non-Italian students, gas. Luce is the energy. So the name that ENI uses for this type of service is any gas and luce, gas and energy customers. As you can see, for this type of customers, it is not possible to classify them within low, medium, high risk, because ENI does not have an internal system of rating for this type of customer. So the total gross amount is 2.1 billion. Look at the allowance. Okay? The allowance is, in this case, 646 million. It's a huge amount. If you compute in percentage, means that the expected credit loss is almost 30%. A very big amount. As you can see, it's not the same for the other customers. The other customer, here you can see the gross amount, low risk, medium risk, high risk. These receivables are not so-called in bonus, so the customer are not in default, but it is necessary to compute an expected credit risk also for the low risk receivable. But look at the amount. The amount, since in this case the receivable, the risk is a very low risk. As you can see, the allowance is equal to 32 million, equal to 0.9%. 0.9%, a very small amount. Why? Because here we are talking of business customer, national oil companies and public administration, and other counterparties with a very low risk. Medium risk, expected credit loss is at the end 0.6%. High risk, 6.2%. Okay? Default receivables means is one. Okay? Default receivables means that ENI has an amount of receivable. Default means that there are some problems already incurred, breaches in the payments, request of delay, and so on. For this type of receivable, as you can see, the expected credit loss is very high, 58.6%, because default so means that the losses are not expected. are incurred. Not sure, but not only highly probable, something that more, because this means that this type of customer, they breaches payments, they are asking for delay, they maybe have just entered into bankruptcy procedures and so on. Okay? And this is the disclosure about the amount in the balance sheet. Then, here, we can see an information, a particular information about only any gas and luce business, so individuals mainly. And here the total amount of this type of receivable, if we go to the previous, as you can see, ENI gas and luce customer, the gross amount is 2.1 billion. This 2.1 billion is here presented according to the so-called aging. This is a very important analysis that companies do in order to determine the expected credit loss. So as you can see, out of 2.1 billion of trade receivable towards individuals, 1.2 is not past due. So NE has to wait for the maturity. And as you can see here, the allowance recognized is very small, because these are not past due. The remaining part, that is a big amount, because it's 900,000 more or less, 900,000, 900 million, these are in terms of millions. All the other are past due. But some of these receivables are past due up to 3 months. Some other from 3 to 6 months. Some other from 6 to 12 months. And unfortunately for ENI, 598 million, so 600 million, are past due for over than 12 months. Look at the expected credit loss. Look at the allowance for this trade receivable, 83.3%. Because if a trade receivable is past due from more than 12 months, as you can imagine, the probability to recover part of this trade receivable is very, very, very low, because this means that you need a lawyer, you need to pay the lawyer, you need to find the customer. Sometimes if the customer is not so easy neither to find him or her. So in this case, the carrying amount of this trade receivable is only 100 million, so with an expected credit loss of 83.3%. So the 29.6%, that is the percentage of losses on the Eni gas and luce, is the result of completely different expected credit losses. From 3.6% for trade receivables that are not past due, until 83.3% for receivables that are past due for more than 12 months. Okay? And this chart is the breakdown of the allowance. As you can see, the allowance at the end of 2019 is the allowance at the end, at the beginning of 2020. Then, part of this allowance has been used by Eni during 2020 for the trade receivable that had been eliminated during 2020. Okay? So this minus 82 minus 275 is the same as our 30,000. So trade receivable, for which an allowance was recognized in the previous periods, and in 2020 these trade receivable are eliminated against the allowance. So for this amount, 82,275,000, there are no impact in the income statement because losses were recognized in the past. Then here, the addition means the increase of the loss allowance. The increase is for 112 plus 231 million. This is the impact on the income statement. It is the same as in our exercise of 130,000. The increase in the allowance in order to obtain exactly the expected credit loss at the end of the year. Is this clear for everybody? Yes?
I have a question on the previous page.
This one or the previous? This is just for Eni Gas and
No,
Luce?
the previous one. Why the medium risk receivables have a lower percentage?
This is a good question. This is probably only due to the fact that these percentage are computed on the whole amount. So probably this is due to some particular information on some particular business customer. This is the 0.6 is computed, as you can see, considering also risk mitigation factors that, for example, insurance and so on. So on the total, 0.6 is lower for medium risk compared to the low risk, but probably because for medium risk they have also insurance and other mitigation action that at the end the loss is only 0.6, even if they are riskier than the other. Okay, you're welcome.
I want to ask, there is no past due. That word means
Past due in Italian means scaduto. Okay? A trade receivable is past due if not past due means they are the customer has time, I don't know, 1 or 2 months to pay. For example, if I sell a product today and allow the customer to pay in 2 months, the maturity is December the 12th. Starting from today until December the 12th, the trade receivable is not past due because it's a right of the customer to wait in order to pay. But if the customer doesn't pay at the maturity, starting from December the 13th, the trade receivable becomes past due because the maturity has already expired, and the trade receivable is past due. It depends. For example, if the maturity is December the 12th, and this is the balance sheet at the end of December, in this case, the trade receivable is classified within this category because it is past due for 17 days or something like this, 20 days, 19 days to be precise.
It is calculated from
The maturity.
from December after. Is the scaduto?
The scaduto is no, the date, the reporting period date. I use just to explain. Okay. This is the maturity of our trade receivable, okay? This is the maturity. If the customer doesn't pay, and we need to prepare financial statement at the end of 2020, okay? This is past due of 19 days, okay? Then, suppose that unfortunately the customer continues not to pay, and E&I has to prepare also the semi-annual report. Okay? So at the semi-annual report, this trade receivable is past due of 6 months and 19 days. Okay. If the customer continues not to pay, at the end of 2020, so at the end of 2021, now the trade receivable is past due of 1 year plus 19 days. Okay. And this means that in the case of E&I, as you can see, okay, over 12 months. If we look on the first situation, okay, if the maturity is middle December and we are preparing the financial statement at the end of that year, in this case it is past due from 0 to 3 months because it is past due from 19 months. Okay? This is why if the trade receivable are past due for over 12 months, it's very hard, very difficult to obtain back the amount of the money.
Possible that the company needs to reduce the allowance from previous year?
It is possible that the company reduce the credit allowance
From previous year?
Oh yes, it is. Because it depends on the expected credit loss is computed in our case here, okay, at the end of December, okay, and it is based on your experience because you know that if a trade receivable is past due for more than 6 months, the probability to recover it is only of X%. Okay? But when you compute this expected credit loss, you need to take into account also the forward-looking approach. So, for example, at the end of 2020, you had to take into account the impact of the pandemic. More families were in difficulties, and so this means that for companies like E&I, a more complex activity to do in order to obtain back the money. So at the end of each reporting period, in the case of a company like E&I that is listed, and so that has the obligation also to prepare the semi-annual report, also at the end of June, The estimate must be updated. So updating an estimate means that the company has to review according to the new experience gained, but also the information about the period, the forward-looking information. This is a very sensitive topic, of course, for a company like Eni, TIM, and generally speaking, the industry that is called utilities. They have millions of customers, but each customer has a nominal amount of the credit that is very, very small. So also the activity in order to recover the credit is quite complex because you need to spread. In fact, in many cases, companies like Eni, TIM, and so on, they use specialized company in order to recover the receivable. Other question? Probably there is a question in the chat. It's not for me. Okay. Okay. This is about receivable.
What's the strategy for the ANI to kind of prevent this kind of situation?
It's not so easy because they have to verify when there is a past due, so they have information system that in theory they can be able to capture the information about the past due very quickly. Then they start to fall. Then they start to, of course, if you don't pay, they can decide to interrupt the delivery, the service. But as you can imagine, here we are talking of energy and gas. So they are very important for families, so it is not so easy. So they know this. It's part of their job. Of course, the problem is that we pay at the end. Okay? Because if a company knows that in average, okay, as you can see, that there is 600 million out of 2 billion. Okay? So this is, at the previous period, 641. Oh, sorry. Okay, 641 out of 2.1. So more or less the percentage is always the same. As you can see, the percentage of the expected credit loss is always the same. So when a company like Eni decides the prices, that there is a part that is mandatory, then now there is the so-called free market and so on, they have to take into account that part of their services, their revenue, is not possible to collect that. So of course, this has an impact on all the other customers. Okay. Okay, I would like only to show with you the provision. So if we go back again to consolidated financial statements, okay, this is the balance sheet, and in the liability, non-current liability, here provisions. Okay? And in this case, we are talking of 13.4 billion of provision. Do not consider provision for employees. These are other types of provision, other type of liability. Focus on provisions, generic provision. Okay? The note here is the number 20. But before going to the note number 20, we need to read sorry, just I would like to use my computer, but it is not possible. Cost income taxes, where are you? Employee benefit here. Here. Provision, okay. Provision, contingent liabilities, and contingent asset. Look at the definition. A provision is a liability of uncertain timing or amount on the balance sheet date. Provisions are recognized when there is a present obligation, legal or constructive, as a result of a past event. It is probable that annual flow of resources will be required, and the amount of the obligation can be reliably estimated. As you can see, the words are exactly the words of our slides, simply because both E&I and I copied from IAS, in particular IAS 37. Okay? The amount recognized, generally speaking, is recognized as an expenditure, and then here there is all the explanation. The note with the numbers, the figures, is the note number 20. So if we go to the note number 20, provision. The total amount of provision is 13.4. Provision is a liability, even if uncertain, but it's a liability. In this case, provisions are for restoration, abandonment, and social projects. I hope you remember that for property, plant, and equipment, when there is an obligation to restore the site and so on, it is mandatory to recognize a provision. I hope you remember also the exercises. And in the case of E&I, as you can see, 9.3 billion out of 13 billion are for this type of provision because of the activity of E&I. When E&I starts to drill into some field, for example, E&I then has the obligation at the end of the use of the oil field to restore everything. And this means a huge amount of provision, a huge amount of obligation. In the case of E&I, 9.3 billion out of 13. Then, another important type of provision for E&I is the environmental provision, other 2.2 billion. And here, in fact, we know that there is also the information here. Look, provision for environmental risk included the estimated cost for environmental cleanup and remediation of soil and groundwater in the areas owned or under concession where the group performed the past industrial operations that were progressively divested, shut down, dismantled, or restructured. This is part of their activity. I don't know if you remember that some years ago, British Petroleum had a terrible spillover in the Gulf of Mexico. Do you remember? Try to think about the amount of the provision for cleaning up all the disaster that they made in the Gulf of Mexico. This is an estimate due to the obligation of Eni to clean up. And the obligation can be legal and constructive. Constructive because in some countries the obligation for cleaning the pollution, and in this case it's just not a matter of pollution but disaster made, is different. But if Eni decides to put in place the same action, this is a constructive obligation. Then, for litigation, in the case of Eni, 385 million, and then other less significant compared to the total amount provision. Here for taxes other than income taxes, so other type of duties. Here for it's a very particular situation for insurance companies, a particular situation for losses on investments, again insurance. This is because of incentives for employees to leave the company and other restructuring provision. But if we look at the most important, provision for restoration of site, environmental provision, and provision for litigation. Litigation here are expected liabilities associated with legal proceeding and other matters arising from contractual claims, including arbitrations, fines, penalties due to antitrust proceeding, and other administrative matters. Okay. As you can imagine, in order to estimate this provision, it is necessary to obtain the legal advice from the lawyers. Please look at provision for litigation. Initial amount 850 million. Then look here. Reversal of utilized provision. What does this mean? Keep in mind, these are provisions for litigation. So utilized provision. They lost the litigation, so they had to pay. So this means that in the case of Eni, during 2020, Eni lost some litigation. Eni had to pay. Of course, the liability was already there, so the outflow of cash, bank account, I don't remember the figure, 526. The bank account was recognized against provision for litigation. The liability was already there, and so it's just a matter to pay. Okay, this is the amount that in the chart is indicated as, in the case of Eni, it's indicated as a reversal of utilized provision. Reversal of utilized provision. Okay? Then, look at the chart. Reversal of unutilized provision, 96 million. What is the reason?
We win the litigation.
We win, the E&I won the litigation.
Or still don't know the exact result.
Or maybe E&I lost the litigation, but the amount to be paid was lower than the amount estimated at the end of the previous period. So this means that this is a change in estimate again. So reversal of unutilized provision. This means that the provision must be reduced, and in particular for 96 million. But in this case, the impact is not an outflow cash. Here, the problem is that during the past years, E&I estimated an amount of provision, an amount of outflow too high compared to the actual amount. So these 96 millions are no longer necessary because maybe the litigation is now concluded, so we don't have any other risk. But if we pay a lower amount, or if we want, in this case we need to eliminate the provision. This is a positive, this has a positive impact on the income statement. Because when the provision was recognized, there was a cost in the income statement. Now that the provision is too high and I need to eliminate part of this provision, this is a gain to be recognized in the income statement. Reversal of provision. This is to be recognized in the income statement. As you I prefer not to use revenue, I prefer to use gain in the income statement. This is clear for everybody. And this happens when the provision estimated in the previous period is too high. And so the company has to eliminate the provision. Too high because now we change our estimate, or it's not a matter of estimate, we win or we lose, but we pay an amount that is less than the amount originally estimated.
So it will be added to cash.
Sorry?
So it will be added to cash after.
No, there are no impact on cash on this type of change of estimate. Think about the NEMOS. This is a change of estimate. The previous year you estimated 96 of cost provision. Now you eliminate it, but it's just a matter of accounting. Look at the bank is not affected. The bank account is affected only when you lose the litigation and you have to pay. Okay? Now look. New or increased provision. 172. Okay? This is the new cost recognized in the income statement for new litigation or also old litigation, but for which you need to update your estimate. So 172 the name used by ENI is new or increased provision. New means new litigation. Increased means litigation that existed also at the end of the reporting period, but for which ENI estimate now a higher amount of loss. So here we need to recognize cost for provisions in the income statement, and we increase the provision for litigation. And the amount is 172. Is this clear for everybody? Any questions? So, this way, don't consider other changes that are not significant. Currency translation differences. Yesterday, I answered to a question of a group about, at the end, exactly this topic. This is a consolidated financial statement. So keep in mind, when we read 385 million of provision, this means that this is the sum of all the provisions recognized not only in ENI, but in ENI and all its subsidiaries. Some of the subsidiaries of ENI don't use the euro in order to draw out their financial statements. They use US dollars or other currency. But as you can imagine, when ENI prepares its financial statement, ENI can sum up only euros. So if a provision is recognized in a subsidiary that uses US dollars, that provision must be translated into euros. And foreign exchange currencies fluctuate always. So this is a difference that is always present, even if there are no new provision, no reversal, the amount couldn't be the same. Okay? The amount couldn't be the same if some of the provision are in subsidiaries that don't use the euro as their currency. Is this clear for everybody? These translations are not recognized in the income statement. If I go back, this is the profit and loss income statement. This is the statement of comprehensive income, the OCI. This is not part of the exam. Okay, I don't ask you anything about the currency translation, but just to give you the information on how to read it. Look here. Where are you? Here. Look. Currency translation differences. Okay? And as you can see, two positive amounts for 2018 and 2019, and negative amount for 2020. These currency translation differences, they are generated when ENI translates financial statements of its subsidiaries from currencies other than euro into euro. Okay? These differences are not recognized in the income statement. They are recognized in the other comprehensive income because, as you can imagine, Eni can hold a subsidiary for decades. So these differences are not realized, and Eni doesn't expect to realize them in the next year. These differences will be realized only when the subsidiary will be sold. And this could happen in 20 years. Okay? So this way we have also discussed these particularities. And I would like to go back to provision, but I don't remember the number. The number of the note here. Look, in this case, look at provision for site restoration. Okay? And look at this amount. In blue. Provision of dismantling, removing, restoring the site. Okay? 955 million initial recognition and changes in estimate. So my question is the following. Think about property, plant and equipment. Okay? Think about the accounting entries when a plant is bought and when you need to recognize a provision for restoring the site, dismantling the site, and so on. Do you remember the accounting entry? So the provision is recognized for 955, credit side. What about the debit side if this is a provision for the restoration of a site? If I'm not wrong, they did exercises on this.
Provision.
No, the restoration site, dismantling, yes. Not provision, but you made the exercise at the beginning about dismantling and restoring site. 955 is the present value of the estimated future cost for dismantling, restoring the site. Okay? So, what is the counterparty of this 955 million in the debit side?
Dismantling cost?
Not in the income statement. These costs are recognized as part of the assets. Okay? So, this 955 million is the amount recognized in the asset, probably planned for Eni. Okay? So if I'm not wrong, don't remember, I have to check. Yes, look, okay? This is the exercise that we did together. And there was the example of company A that bought the plant, and that there was dismantling and removing costs for 250. But if you remember, we need to compute the present value of this dismantling cost. The present value was 138. Look at the double entry record. The plant was increased, asset, and the provision was recognized for 138. Okay? In the case of Eni, during 2020, Eni made this double entry, but with an amount of 955 million. This is the amount of the new provision for dismantling, removing, in particular for Eni, for restoring the site. Is this clear for everybody? This is what I would like you will be able to do. To put together the accounting principle together with real financial statements, in order to be able to read financial statements and to understand the meaning of the figures. So in this case, 955 is the increase for new plant. The total amount is 9.3 billion. Look at this other part. I understand that unfortunately for you companies, they use different words in order to identify the same things. This is for confusing students. Okay? I'm joking, of course, but I clearly understand that for students it would be better that all the companies use the same words. But unfortunately, it doesn't happen. But if you know the mechanism, accretion discount, what is the meaning of this? Do you remember how this type of provision works? Accumulated depreciation is on the asset. If we make the present value of the provision,
Like interest.
yes, it's Alessandro, thank you. Thank you. It's this is the interest due to the fact that it is necessary to increase the provision simply due to the fact that there is the time is passing. So as Alessandro has just written, and sorry, Riccardo, you answered, it is not easy to read together, to look at the students here in the classroom and to read the chat, but this case is exactly the interest to be recognized at the end of year one is interest on provision for restoring the site and so on, and the increase in provision. Okay? In our exercise, the increase was for 4.15. In the case of Eni, this increase is for 190. Accretion discount. In fact, here reads the unwinding discount recognized to profit and loss was for 190 million and was determined based on a discount rate from minus 0.2%, a very strange situation due to the negative interest rate, and 3.7%. Okay? Then, another important information is this one. Look, this is very important. Main expenditures associated with the commissioning operations are expected to be incurred over a 50-year period. So that's true that they have 9.3 billion of this provision, but this is an estimate of something that Eni expect to be obliged to incur in more than 50 years. I'm not sure to be here in the next 50 years, because you, I hope so, because you are young, but for me it's not so, it's, I hope, but I would, since now I am 48 plus 50, it's a good age. Okay? But now they are putting in place activities that are generating obligation in more than 50 years. Okay? And I think that in this way we have the global picture of the activity of Eni, the same for British Petroleum, of course, and other companies like this. Okay? Any questions? No other topics to be discussed for the exam. In the slides there are some other less significant topics. They will not, of course, they are not part of the exam, but they are there. So maybe next year, if you are interested, or when you read the financial statements, not for the purpose of the exam, but for other purposes, you can have a look at the slide if you want to know something more about some particular topics. Okay? The exam will be composed of exercises, cases, analysis of real financial statements, exactly what we have done together. Now, I'm here in order to answer to your questions, or if there is something that you would like to review, because